Something very unusual is going on in the economy right now. If you look at the stock market, it's soaring. If you understand what's actually happening, there's a big disconnect, and I want to explain that to you today. The very first thing that I need to cover is the US unemployment hitting its lowest rate since 1969. Economists aren't optimistic that it will last. So you could see the data, so much has come through at this time. Not only did the unemployment rate fall to 3.4%, which is ridiculously low, the economy added 517,000 jobs in January. This was much higher than what was expected. They were expecting actually 188,000, and instead it was a completely different scenario, 517,000. So if you look at this and try to explain what's going on here, well, this gives, if you think about the most important factor, the reason that you are watching this video right now today is to understand that this whole soft landing theory that the Federal Reserve has continued to project out, and the mainstream media has pushed that out, and of course it makes it down the line, is going to be regarded as something that was just like transitory inflation. This is very worrisome for the Federal Reserve and that whole narrative, because a second wave of inflation is likely to take place as a result of all of this. You got to look at this data. You got to really realize what's happening here, and this is fundamentally a problem for everybody that's going with their base case in that there's going to be a soft landing. You don't have to worry. We're going to ease into this and it's all going to be a-okay. It does not seem to be the case. The economy being extremely strong in some categories actually looks not so good right now, because the Federal Reserve needs more excuses to cut interest rates and to stop quantitative tightening, but they don't have that ammunition right now with job reports and unemployment rates at these levels. You see what I'm saying? So watch this. Look, jobs report shows an increase of 517 in January, crushing the estimates as unemployment rate hits 53-year low. Basically the same data, just breaking it down at the bottom. Leisure and hospitality added 128,000 jobs. So that was the big one. Okay, leisure and hospitality. People are coming back to work in these areas. Businesses are hiring there as well. There's more tourism. These things are, potentially good. Is that what people really want as far as getting a job and, futures and careers and so on? That's debatable, but at least it is a job that is being created. Yes, a lot of that could have just been hired and fired over the last little while. If it's a temporary job, it still gets counted. If somebody has 2 and 3 and 4 jobs, that still gets counted. We know that. We've talked about this before in the other data, but I'm just showing you the stats. Why do I care about that? Why would I highlight the fact that the U3 unemployment rate is not accurate? Why would I show you that the jobs report is manipulated in that if somebody has 4 jobs, they're going to come up 4 times within that, and still highlight this to you and still bring it to you as if it's important? It's because everything trades based on these numbers. They're not trading based on, the numbers that you and I know to be real. They are going by this. The companies that are doing the hiring and firing, all the reports that are being put out, all of the quantitative easing and things, all these decisions are made based on this data that is manipulated. So we definitely must pay attention to it, but we got to know both. We got to know the other side of it too, the shadow stats side and all the other calculations that are done. Very important on both levels. Look, here's a look at the annualized pace of change in average hourly earnings for production and non-supervisory employees across various timeframes, essentially just showing us that that inflationary aspect has started to slow down, but it's still elevated from where we were in previous years. This chart goes back from 2011 up to the present. So they were saying like the wages are growing too fast, this is inflationary and so on. This chart is basically highlighting the fact that that's slowing down. Sectors that exerted the fastest upward pressure on overall wages during the economic reopening of the past 2 years are now driving the deceleration. Just saying that those things that were going well before are starting to come down right now. And some of those to highlight, it looks like there's a lot of colors in there, but education and health services being one that's on top, as well as leisure and hospitality. So those are extremes. And by the way, still above that trend line. So we'll see what happens in the coming weeks and months. US credit card debt jumps 18.5% and hits a record $930 billion. $930 billion. Imagine 19.9% interest rate carrying that balance. What does that look like? I mean, it's just extreme. On average, it's almost $6,000 a balance that people have, and they're carrying that at 19.9%. How could anybody pay that off? I mean, it's unbelievable. So people are doing this at a time in which there's unemployment rate of 3.4%. Do you not see something very unusual about that? Oh, it's just a one-off. Absolutely not. The debt is up. I talk about it every single video I do. The buy now, pay later stuff is going crazy. Auto loan delinquencies have started to rise somewhat from their bottom. We're looking at people that cannot pay their bills in general. These things are telling a story. And number one, it's that the numbers that they give us do not reflect reality. And that number two, we've got very worrying signs incoming. This is when we get into the next aspect. Stock market, look at what it's doing. The stock market loves what's happening. Tech stocks just finished a 5-week rally, the longest stretch since the market peaked in November 2021. What's unusual about this, very unusual, is that these tech companies fired a whole bunch of people. But of course, the markets love that. The markets love it when people get fired, don't they? Isn't that the way it works? Well, what I'm showing you here is that if you really see what's happening in terms of the financial markets, you realize that it isn't to do with what you would think. It's not based on fundamentals. It's based on all of the speculation that takes place right before our very eyes. It's all speculation. Look here, Amazon stock hit the hardest after tech earnings bonanza, despite misses by Apple and Alphabet. Unusual that Amazon was in this position. They fired a bunch of people. They did not build those fulfillment centers that they said they would, so they really slowed down on their expansion. And at the same time, they increased fees, increasing fees on the sellers. The sellers are getting squeezed. I don't think people realize this when they look at Amazon. Amazon, actually the majority of the sales on Amazon are done by third-party sellers. Third-party sellers are doing that, and of course they increase the fees on them as well. So what happens? So a lot of times the seller just increases the price. That's the way it works. Okay, look, I'm going to show you some data, real data. This is important because the yield curves, the yield curve inversion, what is that? I explain it all the time. Basically, if you're going to get debt, if you were going to buy a bond that's 30 years and you're going to buy a bond that's 3 months, wouldn't you expect the 30-year to give you a better yield than the 3-month? Of course you would. However, that has all reversed right now, and generally that's a sign of a recession. In fact, it's a really good indicator of recession. And you could look at these, different ratios. Is it the 30-year and the 3-month? Is it the 10-year and the 6-month? All these different things. And right now, the percent of 10 yield curves inverted is now gotten to levels right at the, the maximum with what we've seen in previous recessions as well. So we're at that range right now, 90% in this case here. A recession is imminent when 50% of the yield curves tracked entered inversion. So we're already way past that right now today. So we'll see what happens, but I just wanted to show you that. And in addition, CEO confidence is down. I mean, it's in the toilet right now. I'm going to check this out and give you an update on this in the next little while, because I think this might turn around in the next month or two. You could see what's happening with stocks. Stocks are doing very, very well right now in general. So we'll see what happens. And you can compare that to the small business confidence index. Same situation, not looking very good. A lot of that has to do with inflation. However, I do believe that that's going to change in the coming months as we see the stock market doing so well. They're no longer concerned about increasing interest rates and all that nonsense. This is for Europe. PMI shows Eurozone business activity returning to growth. So we went from 49.3. So anything below 50 is a contraction. It was at 49. Now above that, it's at 50.3. So when you look here, it's just showing us manufacturing. That's important because we want to see manufacturing taking place in any of these countries so that we can export, so that we can, even domestic consumption as well. But we want business moving, whether that is manufacturing or with services. We want these PMI numbers to be in positive territory, and slightly, just barely moved into that level. And I think that's important to look at, okay? Really, really key stuff right here. I hope this was informative to you. When we look at the data, the hardcore data, we're going to be able to tell that story. And I hope that you see that there's always two sides to the equation. You get that headline number and everybody just thinks they know what they're talking about. But when we break it down like I just did here, it tells a very different story. So if you appreciated that, you got to hit that like button down below. You got to subscribe to the channel. Each and every day I bring new data to you. I'll see you tomorrow. Take care.